If you're looking at today's housing market, you probably feel like you're staring down the barrel of an impossible choice. From the time we're young, we are handed a very specific script. Buying a house is the ultimate non-negotiable proof that you have made it as an adult. To understand why, we have to look at the physical infrastructure built to support that idea. Millions of post-war suburban homes were constructed to cement home ownership as the baseline for middle-class life. This mid-century blueprint wired the American psyche to believe that belonging and financial security were inseparable from a front lawn. But there is a glaring problem today. The mathematical reality of the current housing market completely contradicts that cultural mandate. This map shows the top 50 metropolitan areas in the United States. Right now, in 49 of those 50 markets, renting a starter home is strictly cheaper than buying one. We are not talking about a narrow margin. Across these major cities, renting saves an average of over $900 a month compared to the total carrying cost of buying that exact same starter home. Yet, driven by the fear of missing out, buyers are routinely stretching their budgets to the breaking point, taking on massive debt just to secure a deed. Many buyers accept this financial strain because they believe the joy of ownership will offset the cost. But looking at sociological data on subjective well-being suggests a different outcome. In fact, researchers consistently find that heavily indebted homeowners report lower day-to-day life satisfaction and higher stress levels than renters with comparable incomes. Choosing between renting and buying is no longer about achieving a dream. It is a strict mathematical trade-off between leveraged consumption and liquid investment. The biggest miscalculation most buyers make is treating the monthly mortgage payment as the final cost of housing, completely ignoring the recurring reality of maintenance. The standard guideline passed around is the 1% rule, which suggests setting aside 1% of a home's purchase price each year for upkeep. But budgeting a flat 1% drastically underestimates reality. It ignores the rising costs of property taxes, insurance premiums, and homeowner association fees. Then come the high-ticket items that drain cash reserves outside of basic repairs, replacing an HVAC system or fighting termites, paying for seasonal landscaping. Even if you manage the maintenance, you still face frictional costs. These are the massive transactional penalties, like the 6 to 10% you lose to realtor fees and closing costs every time you buy or sell. This massive trap creates what is known as the 7-year rule. If you move before living in a house for at least 7 years, those frictional costs will almost certainly wipe out any equity you've accumulated. Loading that truck represents a massive reset on your wealth-building timeline, vaporizing years of equity through commissions and relocation fees. A house is not a magical wealth generator. It is an active, depreciating structure sitting on a plot of land, requiring constant capital injections just to maintain its baseline value. If you don't buy, the primary wealth-building alternative is rent and invest, taking your down payment plus that $900 of monthly savings and deploying it into the stock market. Homeowners counter this with their ultimate financial superpower: leverage. A buyer can control a $400,000 asset by only putting down $80,000 in cash. But leverage magnifies everything. It multiplies your upside wealth during a housing boom, but it equally multiplies your downside risk during a bust. To see how that leverage plays out over decades, we can look to the research of Nobel laureate Robert Shiller, who tracked U.S. housing returns dating back to 1890. Charting his findings over 25 years, the real inflation-adjusted appreciation of a home averages a mere 1% per year. Over that same period, an equivalent investment in the S&P 500 historically produced a 5 to 7% real annualized return, significantly outpacing housing. But there is a fatal flaw to the rent and invest strategy. It requires extreme, unwavering personal discipline. You actually have to invest that monthly savings, not spend it. This is the true hidden benefit of a mortgage. It acts as a forced savings account, protecting people from spending their own equity on depreciating consumer goods. Passive, liquid stock market returns can absolutely beat leveraged real estate, but only if the renter strictly and consistently acts like an investor. Even with the math laid out, a major psychological interference factor remains. Humans simply cannot act as rational spreadsheets when evaluating the roof over their heads. We fall victim to the endowment effect, a cognitive bias where we irrationally value an asset higher simply because it belongs to us. This works in tandem with loss aversion. Psychologists Daniel Kahneman and Amos Tversky proved that the pain of losing money is twice as intense as the joy of gaining the exact same amount. In the housing market, these paired biases cause sellers to completely reject market realities. People will stubbornly refuse to sell a home for less than their original purchase price, even when it makes financial sense to walk away. The real-world consequence of this stubbornness is geographic lock-in. Owners end up passing on better job opportunities or delaying vital life transitions just to avoid taking a nominal loss. These psychological biases effectively shackle a slightly illiquid financial asset to a permanent emotional anchor. So how do you apply these macroeconomic realities to a specific personal lifestyle choice? This matrix charts financial discipline against geographic roots. Rent and invest thrives up here. High financial discipline, low desire for permanence. Conversely, buy and maintain fits down here. For those staying at least 7 years, wanting deep community roots and a budget for maintenance. You have to acknowledge the core sacrifice of renting. You give up total control of your living space and deep community integration in exchange for maximum financial optionality. And you have to acknowledge the core sacrifice of buying. You secure total lifestyle control and psychological stability, but at the cost of immense ongoing capital and labor. Ultimately, homeownership is a lifestyle choice disguised as a mandatory investment, while renting is a financial choice disguised as throwing money away.